A short while ago, I talked with the chief economist of Vanguard. That's the giant mutual fund company. Joe Davis says there is a, quote, striking disconnect between how the economy is doing and those new record highs in the stock market.
There is clearly a disconnect between where jobs are today and where the stock market is. And I would ascribe some of that disconnect both to the effectiveness, quite frankly, of monetary policy and helping to stimulate investor risk-taking. At the same time, I think there's also a disconnect that the U.S. economy could be stronger in its recovery, and part of that is due to an uncertainty tax, if you will.
Well, we saw in the Wall Street Journal today that Vanguard's CEO wrote this op-ed piece with this very provocative headline saying that uncertainty is the enemy of the recovery. So let's flip it around. If we didn't have uncertainty, how much growth, how much better off would we be?
Sure. We actually try to estimate that very question. The answer to that question, Susie, what we found is that just since the early part of 2011, so over the past 2 years, had policy uncertainty not risen strongly through the debt ceiling crisis as well as through the fiscal cliff concerns, that the U.S. economy would be over $260 billion higher in a GDP perspective. To put that in every person's terms, that's around $800 per person in the United States. So it's had a palpable effect. I think the U.S. economy would have grown 3% per year over the past 2 years rather than 2% if the level of policy uncertainty had not been so strong and so high.
You talk about policy uncertainty, and we know that the Federal Reserve is meeting tomorrow, meeting this week. To what extent is a Federal Reserve policy impacting this uncertainty? Is all of the stimulus that they're putting into the economy helping or holding back growth?
Well, I think it is helping. It's tough to argue otherwise when you look at the fact that the U.S. economy has expanded at an albeit modest pace despite the elevated level of policy uncertainty. And so I think the Federal Reserve should receive some credit for trying to stimulate the economy. That said, I think importantly, they are starting to point out that there are costs to their strategy. Savers at home and in very low interest rate paying investments, I think, are clearly feeling the negative ramifications of some of the extraordinary stimulus from the Federal Reserve.
One thing that we hear a lot from all the CEOs that we interview is that because of all this uncertainty, they're holding back on hiring. And we're going to get more jobs numbers on Friday. Do you think that we will see any progress on the hiring front?
I think we'll see modest progress, but I still think we have to brace for some disappointments in economic data through the summer. I mean, the fiscal sequestration, some of those impacts are just starting to hit. By our estimates, job growth should be approximately 45,000 jobs stronger per month if we didn't have this uncertainty tax.
Joe, you come in contact with a lot of individual investors at Vanguard. What's your read on how they feel about spending money and investing it? Well,
I think broadly speaking, we are seeing investors, and we do have millions of clients and shareholders, they're continuing to execute on their long-term plan. Many remain fully vested in the market. That said, there is a level of concern, both with respect to the low level of interest rates, as well as just open-ended questions such as, is the recent recovery in the equity markets, is this sustainable? So I think there are legitimate questions, but at the end of the day, we continue to see very strong demand from investors, and they continue to place faith in the financial markets.